Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today, Tuesday, March 22, we have Danielle DiMartino Booth and Ira Harris. Danielle is founder and CEO of Quill Intelligence, which provides innovative leadership on how markets intelligence is conceived and delivered. She's the author of Fed Up, an insider's take on why the Federal Reserve is bad for America, business speaker and a commentator frequently featured on many media outlets. Prior to Quill, Danielle spent 9 years at the Federal Reserve Bank of Dallas, where she served as advisor to President Richard Fisher throughout the financial crisis. And Ira's independent trader, hedge fund manager, global macro consultant trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and a stint most recently. Welcome, Danielle and Ira.
Thanks for having me.
Thanks, Richard. Thanks for making it possible, as usual.
Great. I thought we begin with your global macro view on the economy and the financial markets. Danielle?
I think it's pretty clear that we're going into a slowdown. Years ago, I was in Brussels and I made a speech to the European Parliament and pondered that Mario Draghi would actually shepherd the European economy in and out of recession without ever having raised interest rates out of negative territory. I dare say that Christine Lagarde is going to see the second round of never getting out of negative interest rates, given what's happening there. Clearly, the emerging markets are under increasing strain, whether you're looking at Nigeria or Sri Lanka. You're seeing quite a few countries line up that are feeling the strains of dollar funding necessities. And of course, we have the US economy that appears to be very quickly sliding into stagflation.
Interesting. And your thoughts, Ira?
No, Danielle makes a really good point, especially on the dollar funding issue. You know what? And it's because the media doesn't ask Jerome at his press conferences. Thank you for taking my question, Chair Powell. They never seem to ask about dollar funding issues. And now that Richard Clarida has gone to the great wasteland of speech writers and traders, the dollar funding issue, we're back to the 70s. This is when I was earning my upper level college education, studying what was going to be coming in the from third world loans, as we call them then, which was merely the recycling of petrodollars to finance the higher cost of oil imports. That was all that was going on, and the banks were making a lot of money. And when I sat and interviewed at a few banks when I left graduate school, and I explained to them how those loans were going to blow up, they kind of laughed at me. So when Continental Bank exploded, I got my revenge by being long TED spreads. So went to the golf course that day and said, let's go wherever it's going to go. We're even. Continental shunned me, I shunned them, but I lived longer than they did. So Danielle's point, this is a very big point, and it gets into the role of sanctions and the way that you look at sanctions. And sanctions have a lot more ripple effects than the common narrative wants to dispel. So let's go wherever you want to go.
What are your thoughts on the geopolitical situation, Danielle, and the sanctions?
So I do think that there's going to be a lot of introspection now that we've weaponized the dollar. It's not that this has not occurred in the past. Of course, it has. South Vietnam, Iran, Iraq, Nicaragua. There are instances that have occurred. There is a precedent, but at this magnitude, not so much. And when you're talking about alliances and global alliances, and the fact that you have seen, you didn't exactly see a unanimous vote on the United Nations Security Council by any stretch. And that was something that I think should have given world leaders pause. That being said, I think that we're discovering that when that when Vladimir Putin's military can somehow take out its own communication system, that Xi Jinping may also be revisiting his perceived value of having this great Russian military as an ally when looking at his world order and how he sees the future of one China and whether or not that is indeed going to entail bringing Taiwan back under the fold or not, or at least attempting to do so. So while I do think that the sanctions certainly have revealed a lot of fissures in the financial system, as my friend Zoltan Pozar has written about extensively, who knew that commodities were behaving as collateral in so many of these global transactions? So a lot of risks have been revealed, but by the same token, I think because of how the situation has panned out with Russia, that things are not ending as badly as they could have by weaponizing the dollar.
And your thoughts, Ira?
No, absolutely right. I'm glad you brought up Pozar, because he was certainly, he wrote those two pieces, which were interesting because they got a lot of play. But prior to writing that, he had written that piece imploring Powell to seek his inner Volcker. But then all of a sudden we got those two pieces to follow. So I know that I'm fortunate. I know we're going to do a podcast with Zoltan coming up. So I'm looking forward to that. But he makes those points, and Danielle's point is exactly right. Who knew? Who knew, right? It's the same thing as who knew how much leverage there is in the system. And so when we go down the path of what Peter Bookvar has referred to for longer than anybody else, quantitative tightening, we are going to find out just how much leverage there is. And that means, as Danielle raises that issue, which is how much securitization has taken place with commodity markets to make this leverage possible. Because, in the realm of uber cheap money, which has been sustained far longer, although when I listened to Powell's speech yesterday, I wondered whether he had listened to himself the previous 2 years, or whether he had a totally out-of-body experience. Because everybody thinks that there's no effects. It's like with sanctions. Well, I'm going to do this, and there's really no repercussions. Well, of course there's repercussions. The emerging world is so highly caught up in the debt situation because of cheap central bank money from the developed world that they have gone down the rabbit hole, and there's no way out for them there, because as the dollar moves higher and higher and higher, the costs, not only are borrowing costs going up because they're all pegged to some type of, I don't know whether we should call LIBOR or SOFR, whatever we're going to, but now the cost of buying those dollars to cover their dollar liabilities increases. We are staring, we are going to return to Rosenberg and Hunt very soon. We're not there yet. The bond markets are not where they thought they'd be yet. But when you get that pushback from all the things that we're talking about, we're in for a lot of volatility. That's all I'm going to say. A lot of volatility.
I would agree with that. If I could add one thing, Richard, it's that we're not just talking about the old days of the IMF riding to the rescue of sovereigns that are borrowing in dollars. We've seen a massive proliferation in a post-QE era of corporates, foreign corporates in emerging markets borrowing in dollars as well. And that really makes things more complicated when you consider the fact that China doesn't have the resources to bail out the global economy that it did in the aftermath of the 2015-2016 industrial recession. China has to focus its stimulus internally, domestically, ahead of the 20th People's Congress. And the trickle-down effect to Ira's point could be more complicated than what we would have been talking about in prior cycles, which would have been purely kind of a sovereign debt crisis. We're also talking about, outside of corporate America, corporates, non-financial corporate debt globally that has to be refinanced in 2022 is $1 trillion.
And how do you see that playing out in terms of, global inflation and interest rates?
Well, according to Powell, it's going to be kumbaya, happy-go-lucky, butterflies, rainbows, and It's all about different variations of paint drying, and nothing's going to break. We will see. I tell you, I have stopped following at Quill Intelligence. We've moved what we're looking at. We've moved the benchmark away from the treasury curve on the sovereigns to the credit curve on triple Bs. And so we're following the differential between the 2-year and the 10-year triple B yield, rather than following the traditional 2-year, 10-year treasury yield, which I think the one thing that Powell said that we can believe in his comments yesterday is that he's not paying attention to 2s, 10s. I think we got that loud and clear, because we got to 14 basis points in overnight trading. Now it's closer to 17 basis points, but no matter how you want to slice it, we're pretty darn close to the zero line. But I think that Powell is sincere in saying he's not going to kowtow to the 2s, 10s. Stock jocks, it frightens the hell out of, but he's going to move on, I think, until something in credit breaks.
Well, but let me ask you a question. It was the regional, I think, Fed presidents who were more concerned about that curve. If I read that Kansas City report, it's because the regional banks who really suffer from it, because they don't have all the fee structures built into them that of course, the big money center banks have. So are we going to see some pushback? I mean, I only ask that because you know, your knowledge of the interfed workings is so wonderful that it does shine some light on this. But are they not better off? Well, if they move to quantitative tightening too soon and they get aggressive by selling duration, will they break a lot of things? I mean, they're caught here.
Yeah. Well, so I think it's all over my Twitter feed. Everybody's insistent that the easiest, most elegant solution for the Fed is to sell long duration treasuries right off the balance sheet. That's a no-no. When you're talking about selling things, you're traditionally talking about an operation twist of some kind. You're traditionally talking about, I mean, what happened the last time the yield curve inverted? The Fed had to launch not QE. And the way it did that was not by selling anything, but by buying short rate paper to bring those short yields down and thereby forcibly uninverting the yield curve. But what's being suggested today is that we go the opposite direction. And I don't know that that holds water. It would be such a massive form of tightening, because it would flow right through to mortgage rates, right through the most interest rate sensitive sectors, and in a big way. It's hard to conceive the Fed trying to body slam the economy. It's not done inside the Fed either. And that's why when you listen to Lori Logan, who runs the New York Markets desk, and John Williams, they were one voice. Somebody's finally taught John Williams about the markets. That's refreshing. But they were one voice in how they were going to let that balance sheet roll off. And it was going to be focused and concentrated on what was maturing first, which is, of course, 2022, 2023 paper. So the elegant solution is an extraordinarily tight form of financial tightening that to your point, would blow up the small and mid-sized banks right now have tremendous exposure to commercial real estate. That was not the case in 07 and 08 when it was the biggest banks that had the exposure to commercial real estate. They're smarter this time around. So they know they're still too big to fail, but they don't want to be thrown completely out of business. But the commercial real estate exposure, and it's out there. It's in CMBS, it's in commercial mortgage-backed securities. We know that, but it is really on small and mid-sized bank balance sheets.
So when we say small mid-bank, we're talking about the regionals, but not necessarily the rural banks, right? The rural banks are just carrying phenomenal amounts of agricultural base.
Yes. So we're talking more about the regionals. Yes.
Okay. All right. Interesting. So yeah. So we'll keep an eye on those, as well as the. I love that you're watching the triple B.
Credit curve. Yeah.
I think that's phenomenally important. People tend to get away with it. You know, the equity markets push higher and higher and higher, but we know what some of that is about, more than some.
Well, so much of it is flows, especially right now, because you're committed quarter end. So you've got to rebalance all your 401ks right now that are target date, which is US law, by the way. So if you don't opt into a 401k investment after 30 days of being employed, your employer is obligated to put you in a target date fund. So at the end of every quarter, if you're 30 years old and your bond allocation is supposed to be 30% and your equity allocation is supposed to be 70%, then the system automatically pushes you back into having a 70% equity exposure and a 30% bond exposure. You know, I've spoken about this publicly so many times, but my favorite factoid of all is that the Fed didn't bail out the markets on March the 23rd, 2020. That was a rebalancing date. You had trillions of dollars forced out of the bond market, and you had trillions of dollars forced into the equity market just in order to rebalance target date 401ks. Remember, the largest of there's one fund out there, a Vanguard fund, that's $1.4 trillion outstanding. One fund. And these are the types of automated flows and share buybacks, of course, which are pushing record levels, that act as an offset to what the bond market is telling you is coming down the pipeline.
It's really something to be on top of here, because I don't know what the Fed is going to do here. And again, if they're going to, you know, I read that paper from the Kansas City Fed because Robert Armstrong wrote a great rebuttal to it, and I had to go back and read it. And I go, wow, you know what? They don't really have a clue as what's coming. They don't know what's going to hit them here. They really don't. I don't know whether it's arrogance. It's not. They're not stupid people. Would never say that. Is their arrogance just so great that they just can't possibly see that how they have really? Well, you know, I listened to Jerome Powell yesterday. He talked about these things, and I go, yet you're saying these things. And I know, Danielle, you've been all over this, that they kept pursuing quantitative easing in the face of this.
It is criminal because of the damage that's going to be done to your average working U.S. household that was already buckling under the strain of record high housing costs, whether or not it was renting or owning. And then you pile onto this, monetizing all this fiscal stimulus that creates immediate inflation, which Lacey Hunt will tell you, and the most debilitating form. My friend Torsten Slock over at Apollo, he ran the numbers last week. And if you add up utilities, food, and energy, that takes up 50% of your lowest quintile of earners. That's before housing costs. And, you know, if you can imagine, the average worker bee in the U.S. economy has been pushed further and further out of city centers because of rents. So they have to drive more than they used to. And, you know, and that's going to be harmful. If you look at the middle swath of income earners, a lot of employers right now are saying, time to come back to the office. Sorry, it's time to come back. And so now they've got this new line item, this new expense item that they used to not have. These used to be urbanites who would take public transportation. And now they've got this new thing called a car with a car payment and a house with a mortgage payment and a gas pump to fill up. And God help them if the furnace or the HVAC goes out.
Well, of course, they can always buy an electronic vehicle.
Yeah, well, those are expensive to build too, because the United States has to import so many of the natural resources needed to build one of these things.
And wait till you have to replace that battery.
Exactly.
And so on inflation, what are your views like for U.S. inflation, global inflation? Is it going to be persistent, maybe rising, or just transitory?
You know, I was speaking to a client last night in Singapore, and he was saying the only inflation that exists here is that of imports. And I was in Italy in October, and there was a lot of animosity because of the fiscal spending that had occurred in the United States that had caused inflation to bleed across our borders and into the global economy. So while I do believe supply chain disruptions are going to be coming off, and that inventories are rebuilding, and that source of inflation is going to be coming off its highs, I think we're currently in an industrial recession, as in past tense, when the data settle. So I think that the supply chain disruption, again, part of the supply chain disruption was also driven by outsized demand. And we're not going to have that same demand pull. So your ports aren't going to be as clogged if you don't have as much demand for products coming from overseas, because so many factories have rebuilt their inventories because they were scared out of their minds by just-in-time inventory. And now they've moved to what I call just in case. So, and by stockpiling is not cheap, which you'd have to go back several generations of manufacturers for them to even figure out what it costs to hold inventory. But I think a lot of manufacturers are going to find out. So I think that that particular source of inflation is going to be coming off its highs, as Chair Powell anticipated. That's not the same case for food and energy inflation, and it's certainly not the case for housing. And those are going to prove to be more persistent forms of inflation that have been exacerbated by Russia's invading Ukraine.
You know what you come to a point, and I have to say that on these podcasts with Richard, I've discussed with Louis Gavay and Mark Faber, of course, and even Zulov. The one anomaly, whenever we was talking about bottlenecks and supply bottlenecks, I go, the one that didn't weigh out was food, because we had record harvests the previous 2-3 years globally.
Yep.
And yet food prices found a level and then all of a sudden started rising again. So, and if you watch the Chinese currency, and we talked about that with Michael Pettis, who's I think probably one of the best on China that there is, and that the Chinese were holding yuan because they were busy buying everything. So instead of, like people here accumulating apartments or buying Picassos or buying Ferraris, the Chinese were actually buying things that they knew that they needed. Food being, of course, the preeminent one. And they're talking about right now, they're carrying 18 months of inventory of wheat. So as everybody's suffering wheat prices, the Chinese, so they've actually put their money to pretty good use. And this food issue is going to become very serious, because now we have terrible drought in Texas with the winter wheat crop. Kansas is struggling.
It's a mess. I'm here. I'm in Texas. Wildfires are crazy.
I know. And so, and that was the one thing that didn't fit that narrative that everybody's talking about, because food prices were going up in the face of record crops. So there wasn't a supply issue. There was something else going on. And I think that Danielle's last point is that when you look at food and energy, we are looking at a different world. And you can, as the Bureau of Labor Statistics has, of course, they always smooth out CPI by, we see non-food and energy headlines, but there's no getting around them. And the pain is real. And that's another thing that falls back upon the emerging world. They are going to be crushed here. The IMF, if they're looking to do something, maybe they want to sell some of that gold, and I'm sure the Chinese would be willing buyers at this point, and then subsidize emerging world for imports of food, because food is going to be a very serious issue. It is already.
It is already, and I think that one of the more underappreciated factors, and I'm not in any way, shape, or form trying to be insensitive, but it is pretty obvious that Biden has been trying to do what he can through executive orders to try and keep the stimulus money flowing into the economy. One of the lesser known facts, and again, I'm not in any way trying to be insensitive, but one of the first executive orders he signed into office, when he got into office, was for the USDA to revamp the food stamp program. And lo and behold, on August the 16th, I was up at Camp Kotok, and it was the day that Biden said he would stand by his decision to pull out of Afghanistan in the way in which he did. That same exact day, the New York Times rolled out with a study from the USDA stating that the food stamp program was woefully underfunded. And unlike in prior times, instead of the increase in food stamp assistance going up by maybe 5 or 10%, that it was going to go up starting October the 1st by 25%. 25% for 42 million Americans. That was why, at that point, you see food inflation in the United States disconnect itself from that of the rest of the world, because there was that much more money pumping into United States food consumption. So this was a massive demand shift on the curve by giving more than 1/10 of Americans 25% more to put towards food. That's why our meat prices are so high. Dairy, chicken, seafood. And then you put on top of that everything that Ira just described that's got global influence to it, in addition to the fact that you've got so much drought in the United States. This is a train wreck.
Yeah. And the Chinese have been out ahead of it, by the way, because they've certainly been filling their bins since at much lower prices, especially when you look at the currency, especially versus the Brazilian real. I mean, they bought everything in Brazil. Every ship was loaded. In fact, the Brazilians were importing from the US for certain feeds that they needed.
We forget that at the very beginning of COVID, that as the rest of the world was shutting down, that those Chinese ports were wide open. They had their lockdown very early on. And when commodities got slammed in the beginning, they bought up not just crops, as you correctly say, they bought up everything, copper, iron ore, all on the cheap. And when their economy started to slow and commodity prices globally were absolutely through the roof, what did they do? They started to release them.
No, right. They through that agency that control. Last year they were busy off
absolutely
selling off, and then they replenished it when the soybeans went down to $10-11. All of a sudden they started inching up, and yet, oh yeah, we're going to see another record crop in Brazil. Of course, we wound up not seeing it. So let me ask you something. Will we see price controls from this administration? And part two, how will that affect the bond markets, in your opinion?
So that could be an ultimate game changer to me. And President Biden had the major oil companies meet yesterday. You kind of sense rent control is coming. You get the feeling that at least gasoline price control is coming. And initially it was beneficial. If you look back at 1974, I want to say, when Nixon was in office, I can't remember exactly what year it was that he imposed price controls, but the hangover came really fast. And it was
actually 71.
71. Thank you. 71.
Price and wage. We won't see wage controls, if people remind me, but we could see price controls.
We could see price controls. The only impediment to that, and you see it coming down the pipeline, the only impediment is the constitutionality and the fact that we're so close to midterms. So I don't know what kind of latitude the GOP will give him. I don't know what all he can do in terms of price controls unilaterally without any support from the Congress, because you sure as heck aren't going to get support from Joe Manchin on something like that.
Yeah,
and you've already removed the rule of law for as long as you did for landlords, so they've already taken it on the chin once.
Yeah, I'm just worried with this group. I mean, all politicians love the optics of things, but this administration, and George Packer wrote that damning piece in the, I believe it was the New Yorker or the Atlantic, about the pullout from Afghanistan. I'm not getting into the politics of that, because I absolutely agreed with the pullout. With leaving, how we left will be a different story. But George Packer, who is no friend of the Republicans, wrote a scathing piece about how this administration was only concerned about the optics, that they didn't want to redo of Vietnam. And it was a scathing piece. And then I thought, if we go back to what Biden did right after the November elections, when the White House political operatives proclaimed that this was all about headline inflation that drove the Democratic losses. So what do we get a week later? We get a drawdown from the Strategic Petroleum Reserve. So I was honored. Somebody called me and said, will you come on our radio show to talk about this? And they thought I was going to talk about it in a going way. I said, this is the stupidest thing ever. They said, really? I said, yeah, I'm buying oil right now, because here's what's going to happen. It'll last for 3 days, which it did, went down to $65 from $72. And then I said, here's the good politics of it. They're all going to complain that the large oil refineries are making windfall profits because they were able to swap that oil. Gee, I can't figure that out. So I wrote her a note the other day. I go, it's amazing. I haven't been back on your show since November. There's something I said it's, in a very caustic way, because I'm like, yeah, I'll push back a little bit. If you're going to borrow my time, let's go back and revisit this and discuss what was right about it.
I mean, look at how the administration has handled the oil markets. You know, they're literally slapping the drillers' hands at the same time that they're saying drill. And if I'm, when oil went negative, and God knows how many private equity firms lost their shirts because they shouldn't have been down where I am in the first place, and they didn't know what they were doing. But the lack of investment since then, because of this push to ESG, is fully justified. I mean, shareholders are shareholders, and you have to make investments with your eye on making profits or not. But if you're being told that you're going to be made redundant like the dinosaur in the next 15 years, and the last oil refinery constructed in the United States was in 1977, we're always going to have to import oil, because we're never going to build a refinery that can refine light sweet. We're always going to have to import heavy. So, but again, this might have been a moment for the administration to pull back and say, maybe the future is a hybrid world. Maybe we're not going to be carbon free. Maybe those pipelines weren't such a bad idea in the first place. Give one little bit of hope that there is something to be said for investing in both worlds. But instead, this is an opportunity to go completely green. And look what's happened to gas prices.
Yeah, absolutely. And in terms of we talked a lot about the emerging market debt challenges, turning back to the developed market, like the indebted Western world. Do you see the potential for the conversion of debt, government debt, into perpetual bonds, as George Soros has suggested?
Whew.
Yeah, in terms
you mean a debt jubilee?
The concept of if you have $100,000 bond, you'll never get your money back, but you'll just be paid a fixed interest for life. That type of
that was a good way to put the nail in the coffin of British pound sterling.
Okay.
And you took the words right out of my head. Yeah, it worked so well for the Brits, didn't it?
I mean, again, I think that so much of it is politics going forward this year. I really do. I think you have to try and factor into your thinking the construct of the coming Congress. And to Ira's point, any Congress will spend anything if the water's hot enough that it feels like they're the frog boiling. It doesn't matter who's in charge. It really doesn't. We've seen debt continue to run up regardless of who's been in office, starting with Reagan, by the way. So anything's possible. But I think that there might be a few, hopefully, younger leaders who see the threat to the United States at this juncture as being somewhat existential. And I hope that that is the case, because there's enough that we've done to damage the dollar that we should stop at some point and not just completely take advantage of our position in the world. I think, as I like to say, we took modern monetary theory and universal basic income on a test drive, and the car failed. The engine block busted. So hopefully we've learned a lesson about not saying that there is such a thing as free deficit spending, because there isn't. Deficit spending has resulted in inflation, and very real inflation.
Mm-hmm. And your thoughts, Ira?
Well, certainly deficit spending without any responsible monetary policy. Everybody talks about Volcker. I don't see Powell at all as Volcker. Maybe an inner Greenspan, but if he was Volcker, we would be at 2% right now on Fed funds, which would be fine. And then if you wanted to freeze that and say, okay, here's where we're going to sit, and now we're going to start shrinking the balance sheet, and let's see what's going to take place, and stop, but he's going to pivot. But let's go back to, the last quarter of 2018, when the damage was real. And when Druckenmiller in December said, well, he made the mistake of a double shotgun approach. And I don't think that they have not learned that. Proceed. You don't know how this spells out. Even the Fed's research they don't know how this plays out because they really don't understand the balance sheet yet.
No, and double tightening is, I think Fed speak right now is highly presumptuous.
Yeah, I
borderline arrogant.
Yeah, and Raphael Bostic, when he said 100 billion a month, that's where he was at. Okay, my view is, okay, let's find out. I'm a trader. I'll navigate these waters. Okay, let's find out. I challenge you. Let's find out. And even Powell at the last press conference last week said that he knows, or he believes from the research, that certain amounts of tightening are equivalent to like 50 basis points increase. They don't know exactly what those numbers are, but that's what the theoretical. So we're in a theoretical bind, and we're going to go. But Jerome got cold feet, and I don't think the situation is nearly as great. And now you have 3 or 4 new governors coming on, and these are not hawkish governors, by the way. I've looked at their research. Lisa Cook and Philip Jefferson. These are not hawkish, and even, that great libertarian Jason Furman calls them the most dovish in decades. And I'm being facetious.
Well, I don't think that Lisa Cook is a sure thing. So
no, I don't know that any of them are, but they're there, and now that they've beat.
Well, they're not. They've only come through committee.
Right.
The Senate has yet to confirm. I don't even know that I would put even odds on Cook, because her vote was split straight down the middle on committee lines. And I don't know that she would get the Democratic votes that she needs. Jefferson, I think, is coming in.
Yeah.
I think Brainerd gets confirmed, and I think Powell gets confirmed. But I think net, when you think about what's really going to end up occurring, at least in 2022, if Jefferson gets the vote and he gets in, at the margin, you're going to have one more dove, but you'll still have Waller, who's a hawk, to offset him.
Yeah, he was kind of surprised me though, because he talks tough, but when there's only one dissension,
he didn't dissent.
I know, and that's what I looked at.
Wingman hanging. He used to work for Bullard. He was Bullard's director.
I know.
Wingman hanging. Left the guy standing at the bar.
That's exactly. I said, when I told people, they said, "What do you think of this meeting?" I said, I would expect to see 3 dissents, and the dissents all being like at the UK previous month, that they'd all be for a more higher number. I really expected 3. 1 dissent. And Bullard, he's been all over the map as far as I'm concerned, but 1 dissent, that's it. And then Waller comes out talking tough. I go, where were you?
No, but define tough, Ira.
I know.
In the coming months, and then Waller says we'll start in July. I'm like, July is a dog year from now.
Right.
And that was, I was expecting May 3rd to be launch point for shrinking the balance sheet, and for it to be announced.
Well, that's what we heard from Powell, which is why the markets reacted, I think, pretty interestingly yesterday. The markets give Jerome Powell a lot of credibility. I don't see it. I truly don't see it.
I'm with you.
I don't really believe he's worthy of being reappointed, but I understand that Biden doesn't want another fight on his hands, because who would it be? And now that they lost Raskin,
right?
That's a big loss for this crowd, because she was certainly taking the Fed. I thought, what's her name speech? I don't know whether you saw it. Isabel Schneibel's. Did you see her speech yesterday on green spending?
No.
It was. Go find it. It was like, where are you coming from? But I understand she's doing Lagarde's work, because Lagarde's she's got so much dissension in that board, and every time she comes out, her last 2 press conferences, you could tell how shaken she was. Those were pretty acrimonious.
I tweeted out in the middle of her press conference, because of course I wasn't listening to her. It was on mute, but I tweeted out in the middle of it. It looks like she's got somewhere underneath her nice Chanel suit, it looks like she's got some kind of a shock, that if she says anything that's off script, that somebody's going to electrically shock her. That's how frightened she looked at the podium.
I agree. And that's the second one in a row. So these meetings have been very acrimonious. And now that you have Nagel, Joachim Nagel rather than Wiedemann, I think they wore Wiedemann out. He's I can't fight this rear guard action. I've been fighting it for so many years. I was fighting Draghi. I'm worn out. But now they have some new blood in there. And now you had, of course, after the meeting, then they all come out much more hawkish, Nutt and Holtzman, and they're all really, but I think that exists at the ECB. I think she has some real problems.
Just
real
coming
problems.
to a time.
Yes, I know.
Quickly,
this is great.
Yeah.
Actually, we do it again next week.
Question, Danielle, if you could, your ideas for investment asset classes or trading opportunities, yield curve trading opportunities, perhaps. Any ideas for?
So I would be, if Powell delivers 50% of what he's threatening to deliver, then I think your gold is good. And I will reiterate, and people on Twitter make fun of me all the time. My municipal bond holdings have been very friendly to me. I will say that much. And the little infrastructure spending that we are going to see, the little fiscal spending we're going to see in 2022, now that the legislation's been passed, we're going to see it benefit states and municipalities. So certain ones are run well, and certain ones don't have these massive pension underfunding situations. And they tend to be money good, especially when rates back up and provide entry points into that asset class. So, but right now, I mean, whether you're talking about commercial real estate or the stock market, or if you're talking about a bulletproof balance sheet where the dividend is 150% guaranteed to be solid, then I would be looking at those kinds of stocks. But otherwise, I think so many areas are vulnerable at this juncture in risky assets.
Great, interesting. And your thoughts, Ira?
I can't agree more. I've been for 2 years. I'm happy to say, and we've been on these podcasts. Louis Gavelli, and we've been talking about ag stocks, mining stocks. They've all been good. And you know what? They're making so much money now. Now it's just, do they do stupid things like the telecoms used to do? They got too much money and they just wasted it. Mining stocks have a tendency to do the same thing. They go out and they spend gazillions buying assets they always do it. They just can't help themselves. It's like the board say, okay, we got so much cash we have to go spend. If they don't do that, and I think that they'll still remain positive going forward. And I agree with Danielle on the debt and things that you want to stay away from. Anybody who's carrying a lot of debt, I stay away from. I don't like them when it's at zero, and now I dislike them more because it's going to start to bite. And we saw it already with the commodity firms, right? The last 2 weeks, some of the better ones have been under pressure because they've been cash short, because they've been carrying hedge positions that they had to finance. So there's a lot of issues that you have to pay attention to, but I think selectively you will find quality, and then we're going to wait to see if we see any type of price controls. And I think that's for another discussion.
Awesome insight and discussion. How can our listeners learn more about your work, Danielle?
Come to quillintelligence.com. And or follow me on Twitter at DiMartino Booth. And if you want to reach out to me about a discount for a subscription for coming on your show, please do so. Just email me at Danielle@DiMartinoBooth.com. And if there are any questions that emanate from this, I'm happy to take any questions from your viewers.
Thank you so much. And Ira?
Same as always, notes from underground. And I'm relegated, and I'm not relegated in the negative term, but I like doing these podcasts. I get to sit and talk, and we can actually ferret out things rather than getting 3 minutes on CNBC or Bloomberg. Hurry up, we don't really want to hear what you got to say anyway. But we'll come back to you. So these are great, Richard.
Okay.
Agreed.
Awesome. Thank you so much, Danielle and Ira. Thank you.
I'm waiting for Yahoo Finance to start becoming your main distributor. That would, I think, elevate it, because I think these are important. I think these discussions here are what people need there. It arms you to be able to go out and face the things that you have to face in the world of finance. So thank you, Danielle. As always, it's a great pleasure.
Gentlemen, enjoyed.
Yeah.
Thank you.
Thank you.
Take care, Danielle. Ira.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.